Hi guys, welcome back. What if one of the decade's fastest dividend growers isn't a bank, utility or healthcare company, but a luxury icon hiding in plain sight? This isn't a cyclical story. It's about scarcity, pricing power and a waitlist that stretches years. It's about a company that has such a strong brand that it can choose its own customers. Ferrari. And right now, after a sharp pullback, we might just have the best buy chance of the last 3 years, which is also why I just added Ferrari as a new position to my dividend growth portfolio. And today, I'll explain why I think that now is a great time to buy this compounding machine. And if you're new here, my name is Florian. Thank you for joining me today. Ferrari's performance over the last year was actually quite good and roughly on par with the S&P 500 until the Capital Markets Day on October the 9th. After that, the stock did crash by over 25%. Of course, we'll come to the reasons in a bit. But in the last 10 years, though, Ferrari did vastly outperform the market with 763% total returns versus the 280 of the index. When most people think about Ferrari, they probably think about fast red cars. But when I think about Ferrari, I think about pure luxury that only few people can afford and a brand name that is seeking its rivals. That's also why Ferrari should be counted as a high luxury company like Hermes or Brunello Cucinelli and not as a car company like GM or Toyota or even a premium brand like Mercedes or BMW. This may sound like a stark exaggeration, so let the numbers speak for themselves. Over all of its lifetime, Ferrari only produced 330,000 cars and over 90% of them are still existing today, most of them even in drivable conditions. And just to put it into context, Toyota produced over 10 million cars last year alone. The average Ferrari is driven around 1,638 miles per year. That is far below the mileage of the average US driver that lies at 12,000 miles per year. And at the same time, Ferrari has put a lot of effort into the personalization options of their cars in the last years, and as I'll show you in a second, they are still pushing this further. But this already had the result that every Ferrari that is produced today is unique, with unique colors, tailored materials, and even special equipment. So rather than just a regular sports car manufacturer, Ferrari has become a high-end asset allocation tool for the ultra-rich. This was made possible with the personalized service that they offer in their showrooms and at their dealers. This is also a fairly new strategy for them. And Ferrari is still further pushing this. They just opened 3 new tailor-made centers in New York, Maranello and Shanghai and are planning to open 2 more in Tokyo and LA by 2027. With this focus on every individual customers and by strictly limiting the production volume, they managed to keep the cars scarce, the brand valuable and the margin high, as we'll see when we come to the financials. And we can also see this in their order book that is filled to the brim. In their last quarterly update, which was in June, they even mentioned that their orders are already reaching until 2027 and their capacity until then is fully booked. For us investors, that means that we have at least a certain degree of predictability when it comes to their revenue development. But despite the strong business model and order book, their wide moat and this predictability, their stock still lost over 25% after their Capital Markets Day on 9th October. So why is this? I actually think there are 2 reasons for this. The first is the electrical car estimate that they have for 2030. While it was still at 40% 2 years ago, right now they think that by 2030 only 20% of their sold cars will be fully electric. Instead, the estimated portion of ICE, internal combustion engine, has increased from 20 back to 40%. So they think now that they will sell far less fully electrical Ferraris than they thought 2 years ago. Today, they are shipping 55% of their cars still with combustion engines, while 45% are hybrid. So no fully electric cars at all. That is because they don't have a fully electric car so far. The first one, the Electrica, will be revealed in spring next year to the public. But I don't even think that this is necessarily a bad thing, because the demand for battery electric vehicles is still lagging behind, and especially people who buy a Ferrari are buying for the emotions it represents. And at least for me, a roaring combustion engine certainly gives other emotions than an electric car engine, even if you have a sound engine. Please don't get me wrong. I'm all for EVs, and I think they are necessary and important to get to CO2 neutrality. But let's be honest. A few Ferraris driving around for a couple of miles per year won't make a big difference. But we should also take into considerations that EVs that are produced today are losing value quicker than cars with combustion engines. We know this from Tesla, for example. Now, when we consider what I said before, that Ferrari is an asset allocation tool, this is absolutely a bad thing because it just makes EVs a worse investment than cars with ICEs. The second reason the stock dropped, and what I think is the main reason, is the guidance they showed for 2030. Even though the guidance for 2025 was increased, the one for 2030 has fallen short of the expectation of analysts and only implies growth rates in the mid-single digits. For revenue, the expected growth is only 4.9%, and for EPS it's 5.5%. And unfortunately, this guidance didn't fit at all with the quite lofty expectations that many analysts had before the Capital Markets Day, which resulted in quite some disappointment and I believe was the main reason for the sell-off. But Ferrari is known for its conservative guidance, which is also the reason they already beat the initial targets for 2026 more than 1 year in advance. So I think these estimates are also pretty conservative, if not even unrealistic. I mean, just look at the growth from last year. I don't believe that there is any other company in the world that can increase their figures by as much as Ferraris by only selling 10 cars more than last year. With these 10 cars, which was an increase of only 0.3% compared to the year before, they managed to increase their revenues by 4.4%, their EBITDA by 5.9%, and their EPS by 3.9%. And with 4 new car launches per year between 2026 and 2030, I would expect that this only gets better even without significantly increasing the sales quantity because, in general, newer Ferraris are also more expensive than older ones, and the personalization also increases the margins. Now, we have talked a lot about cars, but what many miss or ignore is that Ferrari is also striving to become a lifestyle brand, including a fashion collection, merchandising, and income from licensing. Now, this part of the revenue only makes up a little bit over 10% from their total revenue right now. And because I saw nobody talking about it, I also checked the development in the last 5 years. As we can see in the report from 2022, where they compared the 3-year history, this portion has not changed much. And unfortunately, this topic is also a bit intransparent because this part combines the revenue from sponsoring agreements, Formula One revenues, as well as merchandise and fashion. But I think there is a small but important difference in the fine print. Because in 2022, their fashion line was not even mentioned here. It was already mentioned in the presentations of the Capital Markets Day back then, but only as a side note. So I think that Ferrari could have some growth perspective here in the long run besides their cars. But this part is pretty speculative. I just saw nobody talking about it, so I want to briefly mention it here. What is not speculative is that Ferrari is actually operating in a market with peculiar trends. And these trends are even stronger than I first expected. Between 2025 and 2030, this market is expected to grow with a CAGR of over 7%, which is not bad, and again, even above Ferrari's own growth expectation for the same time frame. So now that we understand the business, the growth perspective and the market, let's have a look at the cold hard numbers. And let's also rank them with my stock scoring system. First, let's start by looking at the general growth picture with my TradingView dashboard. Here we basically see a nice and steady growth over the years. The net income, EBITDA and EPS did struggle a bit between 2018 and 2020 for a couple of reasons. First, back then they still sold engines to Maserati, which were well below the expectations. In addition to this, they also had high depreciation and amortization costs from newer model startups. And the start of the COVID pandemic that brought product suspensions and closure of their dealers also didn't help. But overall, Ferrari's growth was still pretty good. They get scores between 7 and 10 here, and only the 5-year free cash flow just missed the 7 score with 6.99% growth per year. And by the way, I calculate the EPS and revenue forecast from the analyst estimations. And we see here that these estimations are quite a bit above the company's own expectations that only forecast a growth in the mid-single digits, as we saw earlier. Overall, Ferrari gets a 5 and 10-year score of 7.8 here. Next come the margins that are pretty stable on quite a high level. These kind of margins are quite extraordinary for a car company and are rather comparable to high luxury companies like Hermes, which I think that Ferrari should be compared to and not car manufacturers. At the same time, they also have a pretty clean balance sheet with a long-term debt to EBITDA ratio of 0.5 and an interest coverage ratio of over 40 times. They also have a nice cash buffer of almost $2 billion, so the financial risk is pretty small for them. What we can also see here is that they are steadily buying back shares every year. This is actually a big part of the capital allocation strategy, where they target to use around 60% of the cash for dividends and share buybacks. And both of these should also be further increased until 2030. So this also gives them quite high scores in the financial health and profitability category. They get a score of 8.6 for 5 years and 8.9 for 10 years here. The picture in dividends is a bit more mixed though, because of the smallish yield and the dividend stability. This comes from a cut of the dividend in 2021, but despite this cut, the 5-year growth rate is still very impressive at 22.5%. Overall, Ferrari still gets a 5-year score of 6.7 and a 10-year score of 7.4. The wide moat, low customer concentration and some secular growth also helps them to get a very decent score in quality. I also estimated the manager quality as very high because of their high ROIC and high shareholder returns via buybacks and dividends. The cyclicality, on the other hand, is also pretty high. But we also need to put this into context. Because I measure this by the general cyclicality of the gig sector the company belongs to. In the case of Ferrari, is the consumer discretionary sector. This is one of the most cyclical sectors of all. But compared to the general sector, Ferrari is much less cyclical because of the focus on high wealth individuals who are much less sensitive to economic cycles than the regular consumer. So even if they only get 1 point here, in reality they are far less cyclical. Overall, they still get a 5-year score of 7.5 and a 10-year score of 7.9 here. Unfortunately, neither their valuation nor their momentum is strong right now. The recent dip in stock price has basically destroyed their momentum and the valuation is also definitely not cheap. Overall, they only get a score of 2.3 for 5 and 10 years here. But quality has its price, not only for cars but also for stocks. And when we compare the valuation to their own history, Ferrari is actually closest to the lowest valuation of the last 5 years. In fact, it is around 20 to 25% below their 5-year averages. In total, that leaves Ferrari with a 5-year score of 6.4 and 7.3 for 10 years. So it looks much more attractive for long-term investors than a short-term speculation, which also fits the currently missing catalysts for the stock. But the 22 analysts that cover the company still see an average 1-year upside of 22.5% right now and give a buy rating. The highest price target is even over 44% higher than today's price, while the minimum price target is roughly at the current price level. So at least target-wise, the analysts still seem pretty optimistic for the stock. So last but not least, before I sum this up and come to my conclusion, let's also compare them to some peers. And if you like the video so far and appreciate the research that went into it, please hit the like button and subscribe to the channel to not miss the next one. I am trying to provide high quality research here that goes beyond just looking at the numbers. But this kind of research takes some time and effort. And I never mentioned this so far, but this is now my 101st video that I record. And so far, I have not earned a single penny from YouTube. That means that I'm currently doing this completely for free and my pay is basically the joy from seeing you guys appreciating this. And a small like or subscribe goes a long way to help these videos being discovered by more people. So thank you very much. And now let's look at the peer comparison. I basically split this into two. On one side, I use 2 car companies, General Motors and BMW as comparison, and on the other hand, high luxury brands with Hermes, Brunello Cucinelli and Moncler. I didn't use LVMH and Kering here, which are much more popular, because I just don't think that they should be categorized as high luxury. But from these companies, Ferrari still had by far the best 10-year performance with over 750%, while both regular car companies, GM and BMW, have the last 2 spots. The second best performance actually had Hermes with 630% returns. But in terms of dividend, BMW has by far the highest yield with over 5%. Moncler still has 2.4%, while the rest are roughly on the same level as Ferrari. But Ferrari has by far the highest dividend growth from all of these companies. When we look at the valuation, there is quite a large gap between the 2 regular car companies and our high luxury brands. And by the way, please don't lynch me when I classify BMW as a regular car company. The reason I choose them is because I like them. And they also come from Munich, same as me. Hell, I even worked at BMW for a couple of years, so I definitely don't mean this in a condescending way. But compared to our high luxury companies, Ferrari doesn't seem overly expensive, and especially the pack seems quite reasonable. The picture in growth is a bit more mixed even between the high luxury brands. But again, Ferrari and Brunello Cucinelli take the crown here. The profitability is generally the highest for Hermes though, but depending on the individual metric, there is no really clear winner. What we see again is that Ferrari compares much closer to high luxury than cars again. So overall, I think that Ferrari is a great and very unique company, and especially for long-term or dividend growth investors like me, the current dip presents a great buying opportunity, even if I have to admit that I can't see any short-term catalysts for the company. But in today's market environment, where investors are increasingly focused on companies that can maintain a stable profitability and high-end pricing power through different economic cycles, Ferrari could be a great pick. They fit this trend perfectly. That is also the reason why I just entered a first position in Ferrari. They have been on my watch list for quite a while now, and I used the dip to add them to my portfolio. But of course, that also makes me biased. So I'd be really interested what you think about the company. Do you like them? And do you see any risks that I might have missed? And guys, if you like a high yield more than dividend growth, this video about one of the biggest dividend payers in the S&P 500 will be interesting for you. And of course, this is no financial advice. So before investing, please do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.